Hello, I'm Kevin Walton with C2 Reverse, and I wanted to take a few minutes and explain the reverse mortgage line of credit available growth rate feature that is part of a reverse mortgage line of credit loan. I'm going to give you a few examples with amortization slides on how it works. But first, it's important as of May 2022 that you know there are now a few different reverse mortgages and lines of credit loan options out there, and they each have their own unique rules, and you have to know the features of each one in order to make an educated decision on which one you may or may not select. If you've seen other reverse mortgage videos, here's a quick recap on the different types of reverse mortgages that are available. First, we have the FHA federally insured home equity conversion mortgage, also known as the HECM, HECM. This is the one we see advertised mostly on TV. They're available in a fixed rate lump sum option and an adjustable rate line of credit option. Now there are new non-HECM reverse mortgage loans available as well on a fixed rate and a line of credit option. They each have different rules and have their place. In this video, I will cover just the line of credit options for both types of loans. Each reverse mortgage line of credit loan has an available line of credit to use at your disposal. The available line of credit that you haven't used yet grows each month into more funds you can access in the future. Left untouched, the line of credit can grow into quite a large number, as you'll see, which translates into you having more funds at your disposal to use when and if it's needed. Here's some things you need to know about each line of credit option. What rate is attached to the unused available line of credit? What period of time is the line accessible? Is there a cap on the line of credit growth? What can cause my line of credit to be frozen? How often can my interest rate adjust? And what are the monthly and annual rate caps? So we're going to go over an example here. We have a home that's worth $900,000. They owe an existing mortgage balance of $120,000. The credit line must be in first mortgage position, so the $120,000 must be paid off before you can get the line of credit established, or the unused portion that you can use, I should say. And the difference between the approved loan amount and the $120,000 plus loan fees, what's left over is the line of credit that's available. So I'm not going to go over loan fees in this video. It would just take too long, but I have another video on my website that you can watch under the educational videos section that covers specifically loan fees only. So what we have here, this is a HECM line of credit, and we have a initial rate, a rate of 4.86%. Now you see something here called the expected rate. Expected rate is what we expect the rate to be over the life of the loan. This is for somebody who's 68 years of age. Initial rate is 4.36% plus 0.5% for the mortgage insurance premium that comes with the HECM reverse mortgage loan, equaling the 4.86% interest rate here. The mortgage insurance premium, that also has its own video on my website. Under the fees section, the video I just referenced, it explains how that insurance works. The HECM is required to have this insurance versus the non-HECM does not. So let's look at 5 years. Well, let's look here actually. The remaining loan amount you have left after paying off the $120,000 mortgage is $281,400. Your loan amount approved based off of this age at this rate, and the equity position for this example is $401,400 out of the $900,000 value. Interest rates are the biggest driver when it comes to determining loan amount. As rates go up, reverse mortgage loan amounts go down. And rates have been going up rapidly in the past 3 months here. Since the beginning of 2022, it's really eroded loan amounts on some of the reverse mortgages, all of reverse mortgages. But in this specific case, this is the loan amount we're working with here. So after paying off the first mortgage, we've got a credit line available of $281,400. Now this slide here, this amortization table, you'll see a home appreciation rate of 2% a year. So instead of being worth $900,000, we're estimating the house to be worth $918,000. That's 2%. No payments were made to the line of credit, and no withdrawals were taken out of the line of credit. I bumped the interest rate 0.5% during the first year, another 0.5% the second year, and another 0.5%, 0.25% the third year. So, because we're in a rising rate environment, so I wanted to reflect those rising rates. So your balance on the line of credit that has not been used has grown to $296,860. And at the end of year 5, it has grown to $386,903. This is based off your initial rate of 4.86, and I bumped it 1.25%. So you'd be right about 6% here in year number 5. You can look over here to the right here. This is your loan balance also rising. If you don't make a payment on a reverse mortgage, the interest that accrues for that month gets tacked onto the balance of the loan. And the rate at which the loan balance interest is calculated is also the same rate calculated on the unused portion of your line of credit. They both grow using the same rate on a monthly basis. So we started out with a loan amount of $281,400, a accessible line of credit for $281,400. At the end of year 5, you're at $386,000. It's gone up $100,000 in available credit that you can draw from. At the end of year 10, it's grown to $488,000. And your loan balance has grown to $208,000. At the end of year 21, you're at $832,000 is what this rate has grown to. So that started from $286,000 and went to $832,000. That's enormous. So for a 68-year-old, they would be 89 years old and have these funds available. Let's say if values dropped in your home and went from $900,000 down to $700,000. This line of credit cannot be closed, and the accumulation on the unused portion line of credit cannot stop. They cannot close it and freeze it like they can a regular HELOC. It's one unique thing on the HECM line of credit. The growth feature just keeps on going, regardless of what your home value does. So this is a large number, $832,000, when you start out with $286,000 available. This is the non-HECM. So the non-HECM, same example, $900,000, $120,000 mortgage balance, but your loan amount is not $401,000, it's $451,000. The non-HECMs can give larger loan amounts. In fact, they can go all the way up to $4 million. They do jumbo loan amounts. The HECM does not. Much smaller loan amounts with the HECM. So that's one thing that the non-HECM line of credit can do is larger loans. But look at the rate. We went from 4.86 to 7.485, 7.5%. It does have a monthly servicing fee of $20 a month. and you have an available line of credit of $331,800 at your disposal instead of the $286,000 with the HECM. But it does come at the higher rate. And let's see how this plays out. Now, the non-HECM can give you a higher loan amount, and it also is available for ages 55 and up. The HECM, you have to be 62. So you do have a younger age, you can access this non-HECM loan. Now, going back to the HECM for a moment, the loan is tied to something called the one-year CMT, or the one-year T-bill. It can go up or down no more than 2% per year. That's the HECM. And has a 5% rate cap over the lifetime. So 5% over 4.86 is 9.86. That's the highest that rate can go on the HECM. The non-HECM is tied to the same thing, the one-year T-bill. The one-year T-bill has been rising because of inflation of late. And right now it is about at its 10-year average. So there's room for the rate definitely to go up some. But you can track the one-year T-bill every Tuesday. It's published on a financial website weekly. So you can see where that rate is going. So on the non-HECM, there is no annual cap on how high it can go. But it can go up to 5%. That's a lifetime cap from the original amount. So it can go from 7.485 to 12.485. So it can go higher. Now, as we're seeing here, same thing, home appreciation of 2% a year. No monthly payments were made on the loan. No withdrawals were taken off the loan. Rate went up 1.25% over the first 3 years. So your line of credit has grown from $331,800 here at the bottom, 331, to 336. Now see how much lower that is than the HECM? Here's the reason why. On the non-HECM credit line, the growth rate is fixed at 1.5% for the first 7 years. Then after the 7th year, it stops growing. No more growth rate. On the HECM, it grows for the rest of the life of the loan. That's why it got up to $836,000. So let's look at the end of year 5. You went from $331,000 available to $363,000. Into year 12, 0. Now why is that? Again, at the end of year 7, your credit line available is going to zero out. Actually, your end of year 7, your growth rate stops. See, this number is the same for the last 3 years. And then after year 10, you lose the credit line altogether. It zeroes out. It gets frozen. Big difference between the HECM and the non-HECM line of credit. The non-HECM gets frozen at the end of 10 years. And the growth rate stops after 7. One other very important thing to note on the non-HECM, if property values drop, this line can be frozen. The HECM cannot be frozen for that reason. So those are other differentiating features from each other, from these two loans. And as you see, you have your loan balance swiftly going up to $327,000. It was much lower on the HECM after 12 years. But you did get $50,000 more with this loan than you did the HECM. So for short-term stay, maybe this loan might be a good option for you. It just depends. It really depends on the situation. If you need the maximum amount of money, the duration of time you're looking to stay. The fees are lower on the non-HECM, much lower. So it just depends. You really have to have these loans compared to each other side by side. And I can do that for you in a video, just like I'm doing now. So differences between the HECM and non-HECM line of credit. As I mentioned, the non-HECM, the line stays open only for 10 years. On the HECM, it stays open for the rest of your life. The non-HECM, you must take a minimum advance of 20% of the approved line of credit. So if you're looking to take out a zero balance line of credit just to have for a rainy day, this one may not be the answer. The HECM does not have that. You don't have to take an initial advance on the line of credit with the HECM, except to pay off the loan costs, which are covered in another video on my website. So there's another difference there. Non-HECMs, they stay open again for 10 years. The credit line freezes, growth rate freezes after 7 years. The HECM costs are greater. It comes with an insurance policy. It's required because the HECM is an FHA loan. All FHA loans have something called MIP, mortgage insurance. Again, watch the video to show that explains the costs on the reverse mortgage. I'll go deeper into detail on that. So both loans do have an available credit line growth rate, and both have different rules that need to be looked into that this video won't cover, just to keep it a little shorter. But I hope I was able to demonstrate and distinguish the differences between the HECM line of credit available growth rate and the non-HECM reverse mortgage credit line growth rate. If you have any questions, feel free to fill out the contact form below. I can make a video for you unique to your situation and compare each loan side by side to enable you to make a decision, a better decision, which loan may or may not fit your situation. So I hope you've enjoyed this video and now understand the differences in the growth rate on the two loans. Feel free to fill out the contact form below or go to my, press the button in the upper right-hand corner of my website, which says Tell Me Your Scenario, and I can make a video based off that information for you. So thanks for watching, and please click to subscribe down at the right there to my channel, and any new video I make, you'll get alerted to what it is. They're all reverse mortgage related. Again, thank you. I sincerely appreciate it. Bye-bye.